Thank you very much for joining our webinar this afternoon. Having looked through the list of attendees and those who registered to attend, what's really nice is there are lots of familiar faces. There also are some new ones, and I know actually there's some very new clients of ours. So we really appreciate the fact that you've taken time out to join the presentation. There are also actually a really nice mix of clients and brokers, and that's really nice. So we have a really nice mix of people on the call. For those who don't know me, I'm Nigel Bamber, and I am Head of Customer for Swiss Re Corporate Solutions here in the UK. So as you know, the webinar is about the UK economy after COVID-19, and are there reasons to be optimistic? I'll just say here, actually, there are some Slido questions. So if you could get your Slido apps ready or get ready to go on a link, please do so, because we got some interactive questions at the beginning of the webinar and also during as well. So please get your Slido ready, and the link will be shown fairly shortly. So this is a webinar about the economy. It's not about insurance per se. So please note that. We also know that actually everyone actually in the room has been affected by COVID-19. And we also have some clients on the call whose business has been incredibly disrupted. So we all know that we live in challenging times. I'm not going to talk at all now about the webinar itself, because I'll leave that to Olga Cherkassin to talk about that. But what I would say is she's prepared basically a bespoke analysis for this event, and it's not some sort of generic presentation. And I thank you very much, Olga, for doing that and taking the time. Swiss Re itself defines ourselves as a knowledge company, and we use that knowledge to craft better solutions for our clients. But we also use that knowledge to share with clients and brokers. And in particular, we use an organisation or part of us called the Swiss Re Institute, and Olga's part of that organisation. The Swiss Re Institute has over 200 employees, publishes a vast array of research, has over 30 expertise publications, and I'm sure most of you will be aware of the Sigma report. I'm now going to speak briefly about Olga, and just to check that she is suitable to provide this excellent presentation. And then I looked at her CV, well, I looked at her LinkedIn actually profile, and I realized I think probably she does. She studied in Paris, Berlin and Barcelona. She holds a master's degree in international trade, finance and development. She's worked for the European Commission in Brussels, so we'll just make sure that she is suitably impartial on Brexit. And in London for banks before the heavy heights of the Swiss Re Institute. So Olga, you are very well positioned to talk to us about the economy in the UK. Just some rules, please, ladies and gentlemen, this afternoon. When the event starts, could you please turn off your cameras to preserve bandwidth? And there will be some verbal questions at the end, but please, and if you want to, you can use the client chat box during the presentation with questions and comments, but there will be a chance to ask some questions right at the end. We are recording this event, and you can access the recording after the event, but it won't be shared wider than this audience. So I think we're probably ready to start. Could I have the next slide, please, Olga? Okay, so here's your first question. And it's a word share. So can you choose one word which describes how you feel about the outlook for the UK post-COVID-19, enter the code /UK 2020 or go on the link, and I shall do the same. And when we got a few responses in, then Philip is going to show us the results. So one word, but you can also enter more than one word, as in you can enter a different word if you so desire. Here we go. So we have, maybe not surprising, uncertainty, a lot of concern. Yes, it's we're in an unknown situation, pessimistic, negative. Administration, that's an interesting one. Obviously, someone has got a lot on their mind. Challenge, yes, indeed. Right, well, I guess that's probably a fair reflection. Uncertain and concerned and a bit negative. Olga, please put us out of our misery and make us happy if you can, or just actually just say exactly what you feel is going to be happening. Olga, over to you.
Thanks, Nigel. So thanks a lot for the introduction, Nigel, and welcome everyone also from my side. I hope you can hear me well. So let me first talk about the elephant in the room, which is COVID-19. And obviously, we have talked about COVID-19 every day, and you read it in the press every day, but the pandemic and the economic performance of the UK are inherently interconnected. So there is no way for us around the topic if we talk about economics. So my first claim of today is the worst is behind us, but we will not return to normality anytime soon. So let me explain what I mean with this. So I have a couple of charts with me today, which I want to show you. And I always find that it is important, to see with your own eyes what is going on. And I promise it won't be many. So on the left chart, you can see the 7-day moving average of daily infections in the UK. This is a chart that, you're probably all very familiar with. But I just want to put it up there to take a step back and reflect of where we are. So what we really can see in the picture is that infections have come down significantly from their peak, and they have stabilized at low levels. And in fact, they're now about 10 times lower than at the peak of the pandemic in April and May. So this is a piece of good news up front, right? But on the right side, you can see the Swiss Re Institute Pandemic Macro Club. So this is a monitoring tool that I have developed to monitor the link between the pandemic and the economy. And on the y-axis, you can see RT, which is the reproduction number of the virus. So if RT is above 1, it means that infections are growing exponentially. So every person is infecting more than one other person. So the goal is to keep R below 1. So that's the green area. On the x-axis, you can see a measure of lockdown severity, which is a combination of how stringent lockdown measures are and how much these measures are reflected in mobility. So a move to the left means that the lockdown measures are easing and mobility is picking up. And towards the right, it's the opposite. So the theory goes that countries typically move through all 4 fields of the pandemic over time. And what you can see in this panel is the development of the UK since March 10. So we started off in field 1, which is in the upper right corner. And infections were growing like crazy, which you can also see on the left, right, at this time. And the government introduced lockdown measures. So you can see the line moving to the right. And as new infections eased with R falling below 1, lockdowns were also eased. So we moved into this green area and we moved on to field 3. And field 3 is really what we call the sweet spot. That's where easing continues, but infections do not pick up exponentially. And I have also included this little yellow diamond. So this point is where we are, at least as our latest measure. So this is the 21st of July. So what you can see is that we have moved on from the sweet spot. So that's not so great. So we have moved into the next field of the pandemic. And so R is just above 1. I think it's 1.1 exactly. So that means that every 10 people infect another 11 people. So it's not too bad, but it is not going in the right direction, or at least the direction you want to see. So this is a great tool to monitor the pandemic, and the UK government is also watching these developments very closely, even though I don't think they have such a good tool to do so. But the government is taking action, and as you know, every week we have some news, we have some new measures, we have to wear masks. So it doesn't look like the pandemic is over just yet. So it will probably take a whole while until all these measures disappear from our lives. And we can probably say with some degree of certainty that this will happen when the vaccine is widely available. So the uncertainty for companies and for residents in the UK, and also for the rest of the world actually, will prevail. And this will be for a whole while longer. So I think uncertainty was the word that you picked, and I think this describes the situation very well. And on my second slide, I want to show you the same monitoring tool, but across countries. And I think this is actually very relevant for us in the UK if you think of travel restrictions or if you think of international trade. So when you look at the left chart, you'll probably notice the extremes first, right? So Spain, most notably on the upper right corner, and Italy. They have both moved to the upper right corner. So in a way we can say that they're literally back to square one, at least in our monitoring tool. And I mean, you have probably, or certainly you have read that Spain was added back to the list of the high-risk countries, and you have now to quarantine again if you travel from the UK, and a lot of flights are being cancelled. So this is something that is actually a reflection of this kind of monitoring that policy is also doing. So the other thing that I observe when I look at this chart is that all other countries are actually also in the upper part of this chart. So I have shown this chart a couple of times over the last month, and just a month ago, most of these dots, right, that are representing our major trading partners, they were all in the green area. And what we really can say, it's not just the UK, but it's everywhere. It is difficult everywhere to contain the virus. So to some degree, we have all seen increasing infections again over the last weeks. And on the right side of the chart, well, this is something that I put up there. This is in a way our worst nightmare, right? So that's the US. And as you know, in the US, we also had the peak around April, May. And in the US, there was also an easing of measures, and people thought this is over. There was a lot of protests to ease measures. And but what we see also over time, we have actually experienced a new peak, right? So this is something that we should be mindful of. It can happen in any country, right? So maybe the US was just unlucky, but we really need to try to avert this scenario and not keep or not let our guard down in the UK. Okay, so that's it on COVID from me, and I want to turn to policy and economics. And so this slide is also on the current situation. I will move on in the rest of the presentation towards the future. But just the last one on today. So what we know for sure is that economic lockdowns have helped containing the virus, but they have also resulted in deep recessions, and that's actually everywhere in every single country. And any week of lockdowns and business closures is also a week of foregone business and production, right? So the University of Oxford has created an index to measure the stringency of lockdowns, which you can see here on the left chart. So the higher the value, the more stringent is the lockdown, or the more measures are in place. And the yellow line represents the UK, but I have also included the biggest 4 countries in Europe as a comparison. So if you think back to the beginning of the pandemic, it really started in Europe, in Italy, right? So you can see on the chart on the left that Italy was the first to implement measures, and you see the Italy line going up, and then everyone else follows. And last of all, the UK, right? So the UK reacted late. If you remember, we were talking about the strategy of herd immunities. That was abandoned, luckily. But what you can also see in this chart and the more recent dates is that countries have been able to ease measures and to do so much earlier than the UK. So among these 5 big countries, the UK is the country with still the tightest measures in place. And so in sum, the UK has put measures very late. The pandemic was probably the most severe in Europe, and it has now also the longest lockdown. So what I want to get to is that this is one of the reasons why we believe that the UK may emerge as an underperformer from COVID-19 in Europe. And now coming to economic activity, on the right side, you can see the Swiss Re Institute Economic Capacity Shortfall Index. So this is an index that is based on mobility. And we have looked at different economic indicators, and we find that mobility was the one best predicting economic activity throughout the pandemic. So we have put this into relation with GDP, and in fact, it works very well. So this is a gauge where you shouldn't take it, on the decimal point, but just to see the dimension where we are. And in fact, the Office of National Statistics, so the ONS, has measured that monthly GDP had fallen by about 25% in April in the UK, and it corresponds very well with our index. So we're very happy with this measure. And what I want to show you with this chart is that the UK is lagging behind other countries in the recovery. So you see the trough was in April, and it wasn't as deep as in other countries. But the climb back is also less steep. So in a way, the trough was better, but the story afterwards is not as rosy for the UK. And this is very much in line with the delayed lockdown easing that we see here on the left chart. Okay, so just to sum up, we have recessions everywhere, but in Europe, the UK is certainly among the worst hit countries. So that was about the current situation, and now let's think a little bit more about the big picture. And I want to make a claim that's probably even bolder than the first one. So this one is, we are experiencing the sharpest and possibly the shortest recession of our lifetimes. So let's have a look. We are in a very unusual global recession. So if you think about the big picture, in fact, we're experiencing right now something that has never happened in this way. So we're seeing very different dynamics from any other crisis before. Typical recessions start with a downturn, and the downturn intensifies to a full-blown crisis, and that can actually take quite a while. But what we have seen this time around is an unprecedented speed of economic contraction. So this is also something that you have seen in the last chart, in the activity index. So this is actually much worse than the global financial crisis in terms of how quickly this contraction happened. In the chart on the right side, you can see quarterly GDP growth in the current crisis in red, and a comparison to the 1990s recession in the US, the early 2000s recession, and the global financial crisis. And it's pretty clear that we have the sharpest drop in GDP ever experienced. So this is quite unusual. And we have also an unprecedented degree of uncertainty, as you have noted yourself. We don't really know how the virus will develop, even a week ahead. We are really in the dark, and we have to monitor and to see what is happening every day. But the good news is that we are also experiencing likely the shortest recession of our lifetimes. So in fact, a recession is defined by contraction in GDP. And as I have shown on the previous slide, economic activity troughed in April, and since then it has been expanding. So every week, every month is better than the previous month. So technically we are already in the recovery, and every month should now bring us some good news. And this is all, of course, based on the assumption that there won't be a major second wave of COVID-19 and there won't be a national lockdown again. So now turning to the UK, we expect the UK economy to rebound strongly in the second half of this year and in 2021, but the recovery will be only partial, and it may take many years to return to pre-COVID-19 GDP levels. So on the left side, you can see a chart of our current GDP baseline forecast and of our forecast before the pandemic. So these are our January numbers. I indexed them at 2019 for you. And you can see the line in gray actually takes quite a while to go back to the 100% that we had before COVID. So we expect quite a sharp fall in GDP in 2020. And in 2021, we see a relatively steep recovery, but later on, beyond the immediate bounce back, we are less optimistic, and we think that the crisis will cause some long-lasting damage on the economy. So this is the less good news. And there are three main factors that are waiting on growth. So we expect in the UK unemployment to increase. I will come to that in my next slide. We will also see more bankruptcies. So if you have followed the news in the recent months, we have already seen a bunch of companies entering into administration or being sold off to other companies. And we think this will continue and there will be more bankruptcies. And finally, there is also the point of Brexit, right? So how can we have an economic outlook without Brexit? But I would also like to come to this later. So on the right side, I have also included our forecast for the Eurozone and the US for comparison, which we see, so we see a stronger fall in GDP in the UK, as I mentioned. We think it will be more affected this year, but the recovery will be also weaker than in the Eurozone. And I have to stress at this point that uncertainty is extremely high. I can't say that often enough, especially around COVID-19 developments, but also Brexit and also the speed of the recovery. So overall, if you consider upside and downside risk to our forecast, we have a risk balance that is skewed to the downside. But next, I'd like to turn to the recovery. So the labour market is something that I think will be key to the UK's economic recovery, and it will be a cornerstone. And I'd like to ask you a little question, as Nigel promised that this will be a little bit more interactive. So please use the link my colleague shared in the chat and enter the code UK 2020 on Slido. So I'll wait a little bit as results are coming in. So the question we ask, does your company plan to reduce the workforce in the next 6 months? So it looks like quite a split result. I'm not sure if everyone has voted already, but Yes, I expect that many people will not know, and there are some yes and no's, and it is exactly on balance, which is, I mean, I think it is in a way a good result, but in another way, we have also to consider that 36% of you say that there will be a reduction in the workforce. So with this, I want to come back to the labor market. So I hope you can see my screen. So the labor market will be key to the UK's recovery. And this is my last slide on the economy. So apart from imposing lockdowns, the government has done many things to support the economy. And one of the most important new programs is currently the Furlough Scheme, which has shielded many employees from unemployment and has thus protected jobs, has protected incomes. And with incomes, it has also protected consumption. And consumption is, in fact, the cornerstone of the UK economy. Now, we know that shops were closed and everything was closed for a while. So surely we will see, when spending numbers are released, we will see a collapse in these numbers. But as shops opened, we have also seen quite a strong comeback in retail sales. We had actually surprisingly good numbers already 2 months in a row. And this is the part of the economy that we are most positive about. However, future consumption will depend on the labor market. And overall, 1/3 of the labor force has been furloughed in the UK. So basically every third employee or worker, this is a huge number in itself if you consider it. But when you look below the headline, you can actually see that lockdowns have hit the economy in quite an uneven way. And some sectors have been affected disproportionately. So quite unsurprisingly, the consumer-facing sectors, which are accommodation, restaurants, art, entertainment, and any other recreational services, they have been affected the most. And what you can see in the chart, so this is a survey result from the last 2 weeks of May versus the last 2 weeks of June. So the good news is really that we see an improvement, right? So more people are working in June than in May, and we see jobs are coming back. But if you consider just the sheer size of this number, so end of June, 70% of employees in the accommodation and food sectors were temporarily not working. So that's quite a shocking number, right? And so I'm coming to the less rosy part. At the moment, the furlough scheme costs nothing to employees, right? So everyone can put their employees on furlough and doesn't bear any cost. But from the 1st of August, the cost will be steadily increasing, and the scheme is set to run out in October, by the end of October, if it is not prolonged. So as the costs rise, we expect that companies will look more closely at their planning, and they will think about the costs, if they can bear those costs or not. So obviously any employee you're paying for who you don't need is an employee that you may consider not to bring back. So we think that many workers, many employees on furlough may not return to their jobs. And unemployment is likely to start increasing from August, when the first costs are coming in, but we really expect to see a jump in unemployment numbers in Q4. So again, it's a mixed bag. Jobs, incomes, and consumption have been shielded. They have been protected by this scheme, but it will not last forever, and we will see major risks as soon as Q4, which will slow the economic recovery. Okay, so now I want to ask you another question. So this is my last topic for today. It's Brexit. How could we leave Brexit out, right? So our last question is, do you think your company is prepared for Brexit? And please vote on Slido. So I think results are still coming in, but this is already a good result. So that's also something that we observe for the UK economy. Most companies seem to be well prepared, and many companies are somewhat prepared, at least among the big companies. The small companies are a little where we see the risk. So let me share my presentation again. So Nigel, don't worry, we're just a few minutes on Brexit and then we're done. So my last claim for today is we will get an agreement by the end of the transition period. So maybe also bold claim, you may disagree. But so I just don't want to talk too much about all the details of Brexit, but let me say upfront that a no-deal exit at the end of the transition period is still a high risk and we cannot rule it out. We also don't think that the transition period will be extended. So this is a question I get a lot. And also without the extension, we don't believe that a comprehensive trade deal will be possible. We will at most get a skinny deal. But also on the positive side, I think what we can note that both sides are engaging in intense dialogue, and we know that both sides want an agreement, or at least we hope the UK wants one too. We hear different voices. But it would be also very costly, not only politically, but economically for both sides, if the outcome was a no trade deal, and therefore we are positive that we will get some sort of bare bones agreement. So quite a skinny deal at the end of the transition period, but nevertheless a deal. Several people have asked me also over the past half year or so, what will happen after Brexit is over in January? And I just want to say Brexit is over when it is over. So the agreement we currently expect will lack all sort of detail. And in 2021, talks will continue and politicians will have to sort out the rest. So I personally believe that Brexit will not be over in January. Brexit will stay with us for a whole while longer. And I cannot imagine that politicians will stop talking on January the 1st, right? So they will not cut the phone lines. So the consequence of this is that uncertainty will stay with us for a while longer. And if you briefly look at this chart, so on the left you see a chart of companies saying that Brexit or COVID are among the top 3 risks for the company. This data is from the Bank of England Agents Survey. So what you can see is that in the past few months, COVID has completely overshadowed Brexit. But once the COVID risk come down, Brexit will come back. And you actually see also the line is rising in the last month. So Brexit considerations are on the rise again. And yes, and it remains among the top 3 risks, and it will likely rise again in 2021. So on the right side, companies were asked when they would reinstate any investment or hiring plans that they had put on hold because of Brexit. So this is a survey from Q4 2019, so that's before the pandemic, but I think it's telling nevertheless. So 40% of companies said they expect to reinstate investment plans by the end of this year. Remember, the government promised we would know about the details of Brexit or how the exit looks like in the summer, right? 10% of companies, they said they would do so later, and 40% said they would not reinstate investment plans at all. So the takeaway from these 2 charts is that uncertainty will remain and companies don't invest in uncertain times. So uncertainty will be a drag on the economy over the investment channel. And as I have mentioned earlier, it's one of the main reasons why we are very cautious about the speed of the recovery in the UK. So again, a mixed bag. We are optimistic there will be some sort of trade deal, but it won't be a comprehensive one, and talks will continue beyond January, since certainty is here to stay. So I have just put here my key takeaways, my key messages very briefly. We are experiencing a very unusual crisis, which is the sharpest, but likely also the shortest in our lifetimes. After the peak in infections and the trough in economic activity in April, the worst is behind us. We are improving, but we don't see the return to normality anytime soon, and for as long as the vaccine is not widely available. And as a result, uncertainty will remain high. The labor market is really the gauge we're looking to the most for the recovery. And finally, we expect a Brexit agreement by the end of this year, but talks will continue. And with this, I'd like to give the word back to Nigel before we jump into the Q&A session.
Thank you very much, Olga. So just one last question. Having heard the webinar, how are you now feeling about the UK economy post-COVID-19? So, and you've got three choices: more optimistic, more pessimistic, or about the same. Let's see what Philip. Let's see what's happening now. Thank you. What do we? More optimistic. I think you might have earned your supper, Olga. So that's good news.
That looks good.
Yes, indeed. Now, Olga, you weren't expecting this question, but I'm going to ask it. So you're obviously not a lawyer because you've basically not sat on the fence and you've come up with quite a few predictions. Okay, as regards the deal, or actually we'll basically leave Brexit or have Brexit with a deal rather than without a deal. And what a difference a year makes, because we were like 12 months ago, it was the only thing anyone ever worried about, and now clearly it's rather less important. But in terms of percentages, all right, what percentage would you put on us leaving with some kind of deal at the end of the year, percentage-wise?
I think it's more than 50%.
More than 50. That's a bit on the fence, isn't it?
I think that the risk of a no deal is still considerable, and I think that every company should think about a plan how to address or what to do in a no deal scenario. But we do think that we will get a deal. It is obviously we don't have that much information from the UK government or the EU to really say we are sure we will get a deal. So yeah. I do think it's above 50%.
Okay, thank you for that. So we've got a few minutes left. I have some questions myself, obviously, so I'm fully prepared, but I'd much rather that people on the line ask their own questions. So could you raise your hand if you're able to do that technology-wise? If not, I won't be too upset if you just unmute your phone and ask a question. So any questions for Olga? Raise your hand technically, or ask a question. Any takers yet? Save me from asking my first question, please. Who's going to be brave enough to ask a question? Any takers? Olga, there are shy lot, so I will ask. Oh, here we have. Ah, cool. Okay. Who is that? Ah, Dave. David, please ask your question. Thank you.
Hi, Nigel. Hi, Olga. That's very interesting, very insightful. Thank you very much. I was wondering what your views are on how the government could approach sort of stimulating different areas of the economy. You obviously showed a very interesting chart about the effects in different areas, particularly on, hospitality type, areas of the business or the economy. Do you have any views on, how they could approach a more perhaps targeted view of furlough, or any views on whether they would have an appetite to extend and the implications?
Thanks a lot for the question, David. I think that it's a little bit tricky with this crisis, right? So it's a little bit, so the question is really for the government, do you want to stimulate these sectors? So if you think about restaurants, hospitality, travel, do you want more activity there? And, currently with the social distancing, you will think that maybe it's better if, the restaurants are not packed, right? So because we really want to avoid a second wave. So it's really all about supporting the economy, and surely one is that the government can extend the furlough scheme. So that would for sure help until a vaccine is found, or at least some way towards that. I think that there are a lot of good examples that we can see on the continent of how the schemes can work better. So I think that one thing that I see a little bit less positive in the furlough scheme in the UK is that it's great, like black or white, right? So you either work or you don't work, and you're on furlough. So if you look at Germany or Switzerland, for instance, they have quite different schemes, and you can work 60%, 80%, but you can also work 10%, or you can be completely flexible. And that's something that the UK could consider to introduce. So they have already actually announced some flexibility to the furlough scheme, but it depends, it remains to be seen how this will be effective in the end.
Thank you.
Thanks, Dave. Any other questions from the floor? Anyone want to add to what Dave has asked? Raise your hand or unmute. We have someone else. Keith, please go ahead, and thank you.
Hi, Nigel. Thanks.
Hi there, Keith.
I guess my question is that extending the furlough system and everything else is fine. From an economic point of view and an economist, I mean, at some stage, the government will they run out of money, and therefore, how do they make the decision on when to stop, funding the economy, because down the road we have to pay this back? I mean, I don't know how, if you've got any thoughts on that, because to me it seems you could be, trying to help the economy out so much that actually the pain is the next 20 years of paying off the debt. So I'm just interested in your thoughts on that.
Thanks a lot for the question. So I think this is a very interesting one, because it is really a dilemma for the government. So they have to consider, they want to do a lot, and actually the UK is doing a lot on international comparison, but it also increases the debt. And we actually think that the debt will surpass 100% of GDP this year, which is not really good news. But on the other hand side, they have also, the Bank of England is supporting the government by buying government securities. So the government is issuing a lot of debt, but because the Bank of England is stepping in and buying this debt, the yields on this debt are very low. So if you think about debt sustainability, there are different cornerstones to that. And one major cornerstone is the borrowing costs. And for the UK, the borrowing costs are actually now lower than before the pandemic. So if you can borrow money almost for free, and you can roll over your debt almost for free, that's, that is sustainable in a way. So you will not run out of money in that sense. The question is then obviously for how long you can do it. And I think that the Bank of England will keep their very loose monetary policy for a while still. And maybe also this is the reason why they have to keep it very loose. So we think that the government will not impose austerity, end of this year or next year when we are recovering. We don't see a tightening in measures. But surely a couple of years down the line, they will have to think again about increasing taxes. They have lowered VAT, they have lowered or they have removed many obstacles or deferred VAT payments, etc. So down the line, a couple of years down the line, the government will think about the next steps. And I think that an increase in taxes would be more likely than, again, some sort of austerity we have seen before, where the NHS ended up with very, very little funding, for instance.
Okay, thank you.
Thanks, Keith. Thanks, Olga. We're running over slightly, but I think that's okay. Alex, you have a question, I assume. Please ask away.
Thanks, Nigel. Thanks, Olga. Can I just ask if you could say a few words about the long-term or medium-term outlook for inflation? because one of the things that I find most fascinating about this situation is that inflation was rather low, below the bank rate before the crisis. The government is now stimulating the economy almost in unprecedented size. And if we do have a really quick recovery and private consumption goes back up and the government is still stimulating, is the outlook, I mean, the outlook for inflation is still really, really low. So can the government do anything to get that back up, or are we going to head into almost a deflationary fire?
So I think inflation is a very complex topic, and so I think in the short term, you're certainly right that we don't see or expect to see much inflation, and it has to do with the fact that we expect unemployment to pick up, even with the furlough scheme, right? People don't have 100% replacement of their incomes, so people have taken a cut. And also currently it's very difficult to measure inflation because, inflation is a measure of a consumption basket. And in the pandemic, the basket was not available. So how do you do it? So there are a lot of questions about, the current gauge of inflation, how accurate is it? And given that we do see, that economic activity won't come back to the 100% we had pre-COVID for a while, still, we don't think inflation will increase in the near term. But generally, in the medium to long term, we actually see more risk to inflation. This is a little bit more linked to the debt question earlier. So if we do have a lot of debt and the Bank of England has to keep policy really loose, and the government is also keeping policy loose, we usually see inflation picking up. So there are actually a lot of market participants that are very worried about runaway inflation. I don't think inflation will run away. We haven't experienced that in the last decades, and I don't think there is, at least for the moment, any imminent reason why we should think that inflation is going to spike. But there will be some drivers. For instance, if you think of Brexit, so Brexit will introduce some sort of barriers, right? So pre-Brexit will be, or after Brexit, we have some friction in the system. And typically that drives up prices. So companies will have more cost to deal with. They will have to go through customs. And even if we have a no quota, no tariff agreement that we expect, there will be rules of origin. You have to comply with that. So you have to increase cost. And that means also you have to sell at higher prices. So there are drivers in both directions. Certainly Brexit is one that is driving inflation up in the medium term.
Thank you.
Thanks.
Cool, thanks, Olga. Any one last question? If not, then firstly, a big thank you to Olga for a really interesting presentation. I really enjoyed working on this, but also to hear you today, I think has been very enlightening. Also, I think what is really interesting is I think your answers as well to the questions have also been really insightful. So I'm grateful for that, and thank you.
Thank you.
And also a really big thank you to a couple of people who have kept themselves off camera but are also stars of the show, and that is Leah Malkel and Philippe Rossi for all the hard work in putting it together. Without you, this would not have happened. And so thank you very much for that. And also thank you for everyone on the line for joining in, because we all know you're busy. We all know we've had all sorts of Zoom meetings, team meetings, webinars, etc. So for you to take the time to listen to us, we're very, very grateful. There will be a link sent out tomorrow to the recording if you'd like to listen to this tomorrow or again. But more importantly, there's also a survey, and if you could fill it in, it's really helpful, because we want to make sure we do these events, and we want to make sure that they are really helpful and useful to you. So if you could spend a little time, probably 5 minutes or so, just filling it in. I know it's easy not to, but if you could do, it really makes a huge difference to us and to the Swiss Re Institute, because we then know whether we're doing the right thing or not. So with that, I think I'll say thank you very much. Obviously, we remain open for business. please contact me, any of the other person in the Swiss Re group or network that you normally deal with if you want to follow up on anything. And thank you again very much for your time, and we will see each other soon. Many thanks. Cheerio. Bye.
Thanks a lot, Nigel. Thanks everyone for attending. Bye.